Well, good afternoon, everybody. Today is the end of the month. It is June 30th, 2010. This is Brian Shannon speaking. Let's take a look at these markets. The S&P 500 obviously got hit down $1.14 or another 1% here as this market continues to be under pressure here. And that pressure has to be respected and trusted, basically, the downtrend, as long as we're below this declining 5-day moving average. Now, today you see that I was talking about possibility of getting long the SSO, which is the double SPY, and that was basically right in over here, I believe it was. It looked like the market was going to maybe try to make a run for some highs, and I'd taken some off here and then at break even. So when I talk about a long side trade, again, as I had said this week and many times, that basically we want to give the benefit of the doubt to the sellers on the intermediate term while we're below the declining 5-day moving average. If you learn nothing else from me, remember that any rallies should not be trusted for more than a day trade when we're below a declining 5-day moving average, and that's what we had today. So it's okay to look for a move higher, and I was actually eyeballing this as a potential little head and shoulders, inverse head and shoulders pattern, but I obviously the thought of that went away quickly as the market broke down this afternoon, and it broke back below that volume weighted average price. The volume weighted average price acted as resistance here, and then we had seen a couple of real nice drives lower. I was pointing out the November of '08 low, which was right here at 103.08, saying that was the next significant level of importance on the SPY. Now, we did overshoot that a little bit here, obviously, but you can see that it is the market kind of found a little bit of support in that area. Now, if we lose this level, what will be next? Well, then we'll be probably looking at this next little level. These are the only real area, levels that the market has to look at. So that is 101.99. So let's say we get a gap down tomorrow towards 101.99. Maybe that's where S2 is. Maybe that's an area to look for a bounce. This market, it's dangerous to look for the bounce, though, and most people, myself included, are guilty of doing it when you have a decline like this. But can you switch gears quick enough that if you're looking for a long, can you switch gears quick enough to sell short? Fortunately, for myself, I didn't tweet that, but the pressure remains on the downside here. And as I was pointing out yesterday on that video that I had posted, it seems to me that there's a lot of, the big focus is 104, 103, and that, these levels. To me, it seems more likely that the market will continue down a little bit further than most people expect it to. And I think a test of that 101.50-ish area, which had been resistance back here in November of '08, actually. So you can see that these November levels are important, at least today. And then we had seen support in there as well back in late last year. But that's the 38.2% retracement from the March lows to the recent highs here. So I think that's an area where the market is likely to at least try to stabilize. It doesn't mean the market is going to bottom there. And I see a lot of people putting out different types of tweets on the market saying it's a waste of time to try and find a bounce, and it's absolutely not a waste of time to try and find a bounce. I mean, it may not fit your particular objectives, but this wasn't a waste of time right in here, and this wasn't a waste of time, and the next little move that maybe takes us back up towards 108 won't be a waste of time either. The trick is it, are you going to wait to be objective about finding those turning points, or are you just going to take stabs in the dark? The short term, the longer term time frame is nothing more than the sum of a bunch of shorter term time frames. So when the very short term time frame begins to turn higher, we look at it and we say it's still guilty till proven innocent, but will it have the possibility? Will it have the ability to maybe turn the market the way it did over here back in mid-June, and then we had this beautiful pattern of higher highs and higher lows that we correctly identified that the 1011 area was the place for the that this market had turned lower, and we've stayed primarily bearish because of the declining 5-day moving average, and the market is making lower highs and lower lows below that. So the market, you look at this, we're on all these markets, we're close in the S&P 500 to what they call the death cross, which is the 50-day coming down through the 200-day moving average, and that is a reason again for the longer term concern that the 50-day moving average will likely cross below the 200-day, and then we get a bounce, I would bet. It's not meant as a timing thing. It's more of a general kind of turning point for the longer term trend. But these markets don't just turn on a dime. If you look at when did the 50-day moving average cross the 200, it was actually pretty good in 2007. I will give it more credit, I suppose. But really where the market really found the real selling was after it had broken support, and then that support had become resistance. From there, it obviously, that's where we had really seen the larger damage. So right now it looks like, again, let's just go back and create different scenarios. We could be right in about this area maybe, and the next bounce, if we get it, could be the one that really puts the nail in the coffin, and we see this market continue to unravel. But no markets go straight down. They do for certain periods of time, but they don't. The way that markets decline is that stair-step pattern lower, and we can make some money on these long moves, but they are riskier moves. So we had seen a lot of damage this week to some of the momentum names. Apple down through its 50-day moving average. And if you look at Apple, for instance, because a lot of people ask me about it, on Apple, if we take a look at a 30-minute time frame, here again, the stock was stuck below this 5-day moving average, and the 5-day moving average was declining. It was showing this pattern of lower highs and lower lows, and we're still showing that pattern. So before Apple becomes a buy, in my mind, you don't buy it just because it's touching a 50-day moving average. That's a foolish strategy. What you want to do is you want to say, here's a 50-day moving average. Now this is typically an area where the stock gets a lot of attention, but it's definitely not a buy area is touching that 50-day moving average or getting below it. You can see that there's a lot of volatility around that area, and that, what the 50-day moving average represents more than anything is, here's where an important battle is likely to be fought, and we're looking at a battle being fought here. So someone was just asking me about, can I comment about a channel break on Apple? I don't know what the channel is that you're looking at, but I see an uptrend here, and I see that basically we're really the bigger range in Apple is probably 230 to 275. So I don't know what channel it is you're referring to, because anyways, maybe if you can be more specific on that. But back to Apple, we're in a downtrend, lower highs and lower lows on the intermediate term time frame, and this is the time frame that you really want to align yourself with. This is where you can see that getting back above that 5-day moving average and having that 5-day moving average advancing leads to some great moves. Then we have this kind of indecisiveness and then a breakdown. These are generally, I prefer not to short a stock like Apple. Now a lot of people have been talking about, hey, would you short Apple, or would you short DEC, or would you short Netflix? And I would say no, absolutely not. Now you could have definitely made money in these stocks this past week, but the bigger term uptrends say that these things have turned so many times back higher that they're just much riskier. What you want to do is you want to focus on weaker stocks like LUK, like SHL, LD, SYK. These are the weak stocks. These aren't the stocks you want to be looking to buy, and that sort of thing. So the market, so the S&P 500, I think, again, I don't see that on the daily chart. I don't know what your channel is that you're referring to, so it's tough in 140 characters, but I don't see a break of a channel here, Shah. Shahab. Anyways, let's get back to the S&P. I think that the S&P, today's the end of the quarter and end of the the second quarter of the year, and people have been saying, well, what about window dressing? Well, you just did see window dressing. What you saw was window dressing in reverse, though, that people were looking at their stocks and saying, I don't want to get caught with a whole bunch of these, owning a whole bunch of these stocks that are breaking down. So I'm going to sell into the quarter end, and then maybe they come back and buy them tomorrow. So I think it makes sense that we could, still see a bounce, but I think the bigger level remains that. That 38.2% retracement. And again, there's no magic to Fibonacci other than enough people look at it and sellers start to say, well, I'm going to stop selling as it gets down to that retracement level. And that's not what I meant to draw. What I meant to draw was this. Sellers say, I'm gonna stop selling when it gets down to that 101.50 area. Buyers say, hey, let's start throwing in some bids. And it's the psychology of technical analysis that we're interested in. It's not trying to memorize little squiggles and patterns and foolish little, sounding candlestick formations. Those aren't going to be what makes you money using technical analysis. And when people criticize technical analysis, I think technical analysis gets a bad name because people are trying to just say, hey, cup and handle or head and shoulders or whatever, and a lot of those patterns fail. And this bullish engulfing and bearish, three shooting stars and all that nonsense. It's okay, for that stuff, but you can train a monkey to remember that. What you want to look at is what's the psychology of the market and what is, where are the important levels where a battle may end up being fought. Today, we had seen that the November lows from last year were where that battle was fought. So if we take a look at the NASDAQ next, we lost the 200-day moving average 2 days ago, and we've continued to move lower from there after the 50-day moving average had acted as resistance. That's indicative of really bearish activity and not what you want to see for a market. So this level down here, 42 even down to the 41.70, seems like an important level for this market. If we take a look at the similar fib levels here, and we would take the 08 lows, because that was the low in the NASDAQ actually, that brings us down towards about $41 a share as a potential battleground. The Russell 2000 also closed below its 200-day moving average for the second round basically. This is, it closed below it a couple days here, and then beautiful rally right up to that 50-day moving average. And then we had seen this little bearish flag formation in the gap lower on Tuesday. Well, we're getting into areas where we look at it and say, what's the downside potential in here? And 58 is still the low for the year in the Russell, so we've still got some room to the downside, I think. And if you look at for instance the weekly time frame in here and look at Fibonacci levels, what are the important areas in here? Well, same thing, probably about that 59 level, and that's really right in about with the lows for the year. So 59 is further added as significance because it's the low for the year, and seems like a likely area that maybe it would encounter a little bit of a bounce. The semiconductors look horrible on a weekly time frame. We've got this clear lower high. We've got what appears to be a bigger level of potential support down near about 24.5. If we put the Fibonacci on the semiconductors, we can see here that that level becomes important based on Fibonacci, as well as just the fact that it was this bigger area. So it dropped down towards 24.5. Then I think you would be deeply sold out enough that perhaps it begins to stabilize, but you wouldn't buy it just because it's in there. You still want to wait for the 5-day moving average to flatten out and begin to turn higher like we had seen over here. Now we've still got this lower, we'd seen a slightly higher low here and then resistance at the 5-day moving average, which is declining, and we'd seen the same thing obviously in the Russell 2000. The direction of that 5-day moving average is more important than getting above it for a moment or two. Very similar to the volume weighted average price on a 1-minute chart, or the 50-day moving average on a daily chart, or the 40-week moving average on a weekly time frame, because that 40-week is again the 200-day. Anyways, let's take a look also at the financials. The financials had resistance at their declining 5-day moving average. Financials are capable of bouncing just like any other group in a downtrend. But when the tide turns and we get that 5-day moving average flattened out and turning lower, then it becomes back to guilty till proven innocent. And we look at the daily time frame here. Let's look at the longer term daily. We can see here's a clear level that I'm sure a lot of people are looking at, and that's at 1360 level. Now what happens a lot of times with a widely watched number like this 1360 level, is that we break down through it, because a lot of people say, hey, below 1380 or 1360, this thing's death. And you know, it's already down from 15 to you know, it's already down 10% to get there basically. And shorting after a 10% move in a 2-week time frame generally does not result in the best short sale profitability. Instead, yeah, you can get maybe a little bit further downside, then it rallies back up, traps those short sellers, and the shorts who've been right on it for the last 2 weeks begin to cover, because they see certain guys walking around the floor of the New York Stock Exchange with their realtor pin talking about, hey, well, the XLF broke below $13.60, and that's a big level of support, and all the guys down on the floor are worried about it, and they're just whispering stuff in their ear, in his ear, so they can cover their shorts and trap the public in there. So be aware that, you know, looking at what would likely, in my mind, what would be likely, or the ideal scenario would be a break of that 1360 level, and then we continue down a little bit further and really suck those shorts in, and maybe get down as low as this 1285, 1290 level, and then the market could bounce higher. So we still have what appears to be some downside in these markets. However, it's starting to get a little bit extended to the downside, and these, you know, the short gain, when it becomes too easy to the long or short side, then that's when you have to be a little bit careful. One thing you'll notice on all these charts though is how, you know, we had a nice slow steady uptrend on the financials, on the semiconductors, on the NASDAQ, and on the S&P 500. But what we're seeing here is a lot more fear on the way down, and these markets are coming down quicker, so there's still a lot to be worried about. Let's see, TradingZoo is saying, looking at a 40-year monthly chart, would you throw in a small amount and wait for 10 times for it to 10 times up in a couple years? No, I don't do that. I don't know what that means. Talking about ENER, sorry. ENER, I don't, you know, has this stock been around for 40 years? I doubt it. But ENER is in a horrible downtrend. I mean, I don't know why people are attracted to a stock like this. ENER is in just this terrible, terrible downtrend, and to me, you're just gambling buying a stock like this. So anyways, I don't see any other questions here, so I'm just going to point out a couple more stocks where we had seen some big damage this week in leading stocks. You know, Las Vegas Sands, LVS. If it's below a declining 5-day moving average, you can't trust it. As good as a stock may look on the daily time frame, it looks like a normal pullback. While it's below that 5-day moving average, you don't want to trust it. We saw the same thing with Dolby. DLB has been a big market leader over the last year or so. DLB. Dolby looked like it was consolidating nicely in here, and it got above that 5-day moving average. But what was the direction of that 5-day moving average the whole time? Again, Apple looked like maybe it was going to consolidate in this area and find some support, as did Netflix. Okay, now these markets looked like they were consolidating and getting ready to move higher, but they all had these declining 5-day moving averages and didn't break above significant resistance to take them back up there. So anyways, I don't see any other questions here, so I guess that's going to wrap it up. How about thoughts on panel for Javier? PANL, as you said, it's a thinly traded stock, and it's just, I mean, if we were in a healthy, it's 566,000 shares. If we were in a healthy environment, then I would like panel a lot more than I do. But right now, you look at panel, it's had this, you know, these nice thrust higher. It looked like it was trying to find support at this 20-day moving average, but now it's just kind of really choppy in here. I guess I just don't trust the stock right now. Anyway, so that's going to do it then for the questions. So thanks everybody, and have a great rest of the week trading.